Mark, welcome back to the podcast.
Thanks for having me, Owen. It's always great to be back.
It's always good to chat, mate. Just spend a little bit of time talking about the year that was, and we will spend a bit of time talking about that year that will be. We've got some ETFs. We're going to talk about some of the better performers, some of the lesser performers, and also some of the closures, like what happens when an ETF closes. But Mark, US market up 30% last year. I'm thinking of like S&P 500. Aussie stocks plus 20%. I mean, that surprised me. Did any of that surprise you? And if so, like what falls out of that? What learnings?
Yeah, it was a fantastic year to be invested in the market. I think when you look at the US market doing 2 successive years of 25% plus growth is quite an exceptional anomaly. I think that was the best 2-year consecutive performance in a quarter of a century. And if you go back, if you think about it, the last time that happened, what followed was the dot-com boom. So whether that's a sign of things to come or not, I wasn't too surprised that the US did so amazingly well. A lot of the earnings growth came from the US, and share prices tend to follow where earnings are going. It was very much a risk-on market. I think there were the stats that we had to look at in 2024, 92% of ETFs made money, and that was the best since 2019. So, not just throwing a dart at an ETF board, you would have made money, but it was a great year to be an investor. A lot of people may have been worried about what's going on, geopolitics, war, Trump coming in, but with inflation cooling, interest rates falling, it tended to be a very good year for markets. And in Australia, I mean, it was all about the big banks just continuing to lead. And the fact that the ASX 200, returned also double digits as well. Another great year to be an investor, and we're still pretty constructive on the year ahead.
Yeah, that is so true. If people cast their mind back to all the fears of 2024, the beginning of the year, US election campaign, things going on in Europe, things going on in the Middle East, just so many things to worry about. AI is it good or bad or nothing at all? Like so many different things. And then you think, now you look back and you're like, there's nothing to worry about kind of thing from a stock market perspective, right? So you mentioned it just at the end there. I don't want to give away too much of the secret sauce of the episode at the very start, Mark, but because I'm going to ask you about things you're looking at this year, like what's your game plan for the year ahead, right? But are you worried about where markets are now? Does that spook you in any way, thinking about, you mentioned .com, for people that aren't aware, there was a .com bust after the boom. So are you worried?
I think a lot of people can draw analogies based on what happened in history. I just talked about a stat. The last time we saw those double-digit returns over successive years was the dot-com boom. The last time we saw valuations as high was during the dot-com boom. And, there's a saying that one of the worst things to say is this time is different. And I also saw another stat that in terms of when you're looking at the market breadth, so you're talking about like how many individual companies are outperforming the index. Right now we're at historical lows. I think in the US, you're looking at it's like 15 or 20%. And again, the last time that happened was before a crash. The yield curve's just uninverted back to positive. What happens next? A recession. So a lot of people may have this recency bias or look at history and think, the next period that's coming forward doesn't bode well. But there's a lot of Armageddonists out there that it's in their interest to say, don't be invested or to park your money in cash. Unfortunately, as investors, we don't know. So the best thing to do is just have a good plan in place, have the right things in your portfolio, have things that might not be as sexy right now. So right now, bonds could be an interesting topic because even though they haven't performed as well as AI stocks, with yields now where they are and potentially on the way down, could be a great time to lock in those yields and have a little bit of capital gain appreciation. Gold is another topic as well, also done really well. So when things are really optimistic, you want to also have defense in your portfolios. So I believe that it's important for investors to remain invested. You've got huge capitalist machines in the world right now driving a lot of meaningful income, both on the top line, the revenue line, and the earnings side as well. AI is a big factor when it comes to that. So for me, it's not about, things are looking toppy in terms of elevations and we're now in that 90th, 95th percentile. It just is a room to maybe take a little bit of caution, maybe adopt a different approach. We've talked previously about, having a bit of a valuation tilt and using growth at a reasonable price. Those are the types of things that investors can be thinking about. But overall, I still think being invested in equities in itself has been quite rewarding. And I think it will continue to be, particularly for investors who have a long-term horizon.
We did actually talk about that. For folks that aren't familiar, we talked about the GARP ETF that you guys have at Global X. growth at a reasonable price. And we talked about like the Buffett approach versus the Peter Lynch approach and all that sort of stuff. That was a good bit of fun.
Yeah, and it's actually performed exceptionally well. I know we're recording this at the start of the 2025 quarter, but to end 2024 is one of the best global equity strategies out there, outperforming the broader world index, even outperforming some of the single factor quality ETFs. And it's interesting because it got it's interesting because it also got the timing right of certain stocks like Tesla, which it had in the portfolio, which was quite controversial. But as its valuation got a little bit way into the extreme given its earnings, it actually sold it just before it had a 20% drawdown, which talks to the methodology doing its job. So yeah, those are types of strategies we're looking at Global X to build intelligent, smart strategies that people can put in their portfolios. And I think GARP is particularly timely right now with valuations where they are.
Yeah, interesting. Like you and I weren't even going to talk about this necessarily, but that's interesting that it outperformed most quality strategies as well, because most people look to quality, well, to be honest, all the time, but a lot of the time when valuations are high, they're like, well, maybe I won't go with just the biggest stocks. I'll also go with quality companies that will survive whatever recession gets thrown at them.
Yeah, definitely.
That's interesting.
And I think when you're investing in quality, it's an important filter to have, a strong balance sheet, strong return on equity, but you also want companies that are growing their earnings. So a lot of quality ETFs might look at earnings variability or looking at like what's the volatility of those earnings. So if it's static, it might still be in the portfolio, whereas the GARP strategy focuses on earnings growth overall, but then it has that valuation tool where if things are getting a bit too expensive, probably not the right thing to be owning. And then as part of its rebalance, Berkshire Hathaway was the top holding in the portfolio. Some other holdings like NVIDIA got sold down a little bit, but still growing double digits. So it's still important to own companies like NVIDIA. So when you look at the top 10 holdings, it does look a little bit different towards some other global equity strategies, even though they're still holding big names. And that's how you can complement it quite nicely.
That's interesting. I love that you brought that up too, because for me, like one of the questions I get all the time is, like the market's gone up, should I sell? But it's like your money's going to have to go somewhere, whether it's bonds, which you rightly pointed out as an option, gold, which I'll come to in a sec. You'd probably always want some shares, whether it's just for the income or the long-term growth. Like you can have, we'll probably talk about this as well, like short-term outcome versus long-term outcome. Short-term might be painful, but long-term might be the right position for you. But I'm glad you brought that up because it kind of counters that argument. It's like, well, the market's high, I'll pull out and then I'll wait for it to fall. I just hate that argument because it's like you've got to put your money somewhere. So like having a GARP strategy complement that is really useful. How about gold? So we don't hold gold. I've got to admit, like I've been one of those kind of gold bears, but after the last year, I'm just like, because I'll tell you what I thought, Mark, and you can tell me where, like all the ways that I'm wrong, is I thought rates are on their way down. We'll position in bonds, which hasn't been bad. It hasn't been great, but it hasn't been bad. They'll give us some income finally. So we don't need gold anymore. So we sold out of gold like 2 years ago. Like obviously that's probably the thing that I'm kicking myself because the GOLD from Global X, by my numbers, up 38% last year. It's crazy. Isn't it?
Yeah.
Like,
yeah.
Was it supposed to do that?
No, you don't actually want gold to be performing well. You actually want gold to be your worst performing asset because it means everything else is doing quite well. But I think we're in and I would have also honestly been quite surprised if you told me gold did 30 to 40% last year. But I'm also not surprised because it was kind of a good recipe for it because rates were on their way down. And when real rates fall, that tends to do quite well for gold. But you also had a wild year of geopolitics. And when there's a little bit of, when people are unsure and they need a safe haven, they want to move into something that has a long-term history of preserving wealth, right? Whether it's as an inflation hedge, whether it's as a debasement of currency, de-dollarization, people want to be moving into that. And not just that, but with the likelihood of the US coming in, the dollar rising as well, which tends to be quite negative for gold actually. A lot of central banks wanted to increase the reserves that they're holding on their balance sheets. And you saw a lot of buying from central banks. And what tends to happen is that when institutions, central banks, and then even ETF, gold ETF were in outflows for the better part of 2 years, I would say, even with at record highs. And you start to see a bit more buying back into it. So my view is that gold is an incredibly important asset to own, not just as an inflation hedge, as an defensive asset, but even though it doesn't produce anything, and this is where the criticism we get is I should own gold miners or I should own something that actually produces a cash flow, it actually has a really good track record of preserving that wealth over time. And yes, you are going to get gold bulls who are just like, gold's the only thing to own fiat currency is going to drop, and hence you get in the topic around Bitcoin versus gold. But I still think gold in itself has, for centuries, performed well, actually done very similar returns to the share market as well. So you don't want it to be the best performing asset in your portfolio, but there's still a lot of tailwinds this year as well, especially inflation coming down, rate cutting, very, very supportive for gold as well. It wouldn't surprise me if gold has another really good year. Probably not as good as the last couple of years that have been. There probably is due for a little bit of a pullback, but I have seen some analysts saying that it could reach, $3,000 $3,000 in terms of the price target. And right now we're sitting at about 2,800. So there still is potential upside.
Yeah. We exchanged an email yesterday, and because we're going to talk about some of the top performing ETFs, some of the lesser performing, and some of the closures and things like that. But you mentioned potentially talking about Bitcoin and Ethereum. Global X has the eBTC and the EETH for Ethereum. So that narrative around gold was kind of almost on steroids over in that crypto market, the Bitcoin market. Do you want to talk us through that?
Yeah, I think last year was I said it before, a risk-on environment. And what is the best, I guess, that high beta approach to the market is you want to get exposure to things like cryptocurrency. So we started 2024 in a year where, luckily in Australia, we were quite innovative and had Bitcoin ETFs available for investors to put their money in. We were the first ETF here in Asia Pacific with a spot Bitcoin ETF launching in 2022. And it didn't do too well over those first 18 months, I would say. But then what happened? The SEC gave birth to these, they called them the newborn nine ETFs that people started putting a bucket load of money in. I think they finished the year up 30, 40, $50 billion in it.
Wow.
I think the iShares product that was really successful in the US, I think their Bitcoin product is now bigger than their gold product. So you saw a lot of adoption, whether it be from retail investors, financial advisors, and naturally what happens is Bitcoin ETFs had to go out and buy Bitcoin. So the price propelled really high. And now I think Bitcoin, in terms of the overall supply, there's only, 21 million units in circulation. Bitcoin ETFs now hold around about 6 or 7% of that total supply. It actually owns more Bitcoin than Satoshi Nakamoto, the famous, founder of Bitcoin itself. So that propelled the price even high. And then you had Trump coming in, winning the election, building out his cabinet, pretty much saying, we're going to create this massive digital reserve, this Bitcoin reserve. I'm going to implement all these cabinetry who have these pro-crypto policies. And it wouldn't surprise me, Owen, if we see this year more crypto ETFs come to market as well. So that's why Bitcoin in itself, almost, doing 146% last year, which was the performance of our Bitcoin fund. And even this year, it's actually off to a pretty good start as well, still north of $100,000. To me, Ethereum might have to do a little bit of catching up to it. They are obviously got different applications towards it, but it proved to be a great year to be a Bitcoin investor. And I think this year also seems to be quite constructive. And that being said, you have to be willing to see if there is a crypto downturn. There have been years where it falls 70, 80, 90%.
Can go the other way, I guess.
Exactly.
So we've got crypto, like a Bitcoin and Ethereum assets going nuts. We've got gold on a tear, things like GARP and these types of things. I also think that in a similar vein, FANG was again an outstanding performer, like the big tech, the mega cap tech stocks, that's the one, in the US were winners. I feel like that's not just because of all the things we just mentioned. I feel like there's multiple drivers that there's the cost out from they made a huge amount of redundancies and scaled back on cost post-COVID. They have now embraced AI in a massive way. They're leading the cloud computing, which enables that. There's NVIDIA and all these things. That, again, caught me off guard. Co-host of the show, as you know, Drew, he's laughing all the way to the bank. I think it's his greatest call of all time. And in our fake portfolios that we've put together, Mark, FANG features in mine because I don't want to be left behind if Drew keeps bragging about it. But
you're like many investors, it's almost you can't be underweight these companies. And that's where a lot of big fund managers have underperformed their broader benchmarks or broad indices because they haven't owned them. And I think that's a great way for Australians to have it in their portfolios, even though they might have other things, is to have it as a part because these are some of the best, we talked about it before, the best capitalist machines we've seen. And a lot of people will say, well, it's too concentrated. The top 10 are always changing. If you go back 20, 30, 40 years, it wasn't, the Apples, Microsofts, Googles, etc. But these companies, even though it is quite concentrated, they are making up a huge part of the earnings that's in the broad index, a huge part of the free cash flow as well. So these are cash machines. They are buying back their shares as well, which to me says something. They're investing in their underlying infrastructure. They're building out data centers, and they are seeing something that I think all the world wants to lean towards, and that is, how do we build sustainable businesses, continue to grow at double digits, and also make sure that they, like you said, are paying attention to cost. The issue now is they are priced for perfection. And we're recording this podcast this week where there's going to be tech earnings. It's not just about beating earnings, it's now about beating the beat. And that's going to be, can they live up to those expectations? We think they still can, and we still think that they're going to be fueling a lot of M&A activity as well. If they can't do it themselves, they will be buying businesses that can do that. So I still think that these mega cap tech names, while people might say, Mark, it's too overvalued, you almost can't not own them in your portfolio. Otherwise, there is a chance that, you may have some deviation from the broader benchmark.
It's kind of like the banks here. It's probably to a lesser extent because they're very different beasts. Like those things in the US are growing like, they're just nuts how quickly they grow and consistently. Here, it's more a valuation expansion, but it's a similar thing. Like if you called CBA expensive a year ago, you look silly now. I mean, who knows? Maybe they're going to be right in time, but you need exposure to some companies. You just need them.
You do. And I mean, Australians have exposure to the banks for their income. They're a huge part of our market. That being said, they are the most expensive banks in the world, trading at 3 to 4 times book value. When you look at their returns on equity and their actual price to earnings, they're technically in that quadrant where it's low profitability, low return on equity, and expensive versus some of the other global banks. It's not a reason not to own banks. People need them for their income, but the dividend yield on these companies have also dropped quite low. So there could be a reallocation of capital to broader companies within Australia that might exclude the banks or might exclude even the resource companies, which haven't done as well. They've also been in the bottom performers over the last year too. The difference with the US side is when you look on a forward earnings basis, they're not trading at expensive metrics, and they are high returns on equity. So it's actually quite different to the Australian banking side.
In our portfolio, I've got OZXX.
Love it.
Yeah. So this is the Global X Australia X Financials and Resources ETF. For anyone that's not up to date with what we're talking about here on the Australian Investors Podcast, we created 3 portfolios at the beginning of the year, and Drew, myself, and the community got the chance to contribute to the portfolios, and you contributed, and that OZXX is in there. So that's just what you can explain.
Yeah, I was going to say, that's not my call to say that OZXX is going to be the best performing ETF this year, but I think it's an interesting way to play the Aussie market. If you're worried about bank valuations, and particularly in a rate cutting environment, we just had the the inflation data come out a couple of days ago, and pretty much there's like a 95% chance in February there's going to be an RBA rate cut. I mean, we'll see when this episode comes out if it does happen. And then there's the resources side, which hasn't performed as well, but if people are still concerned about what's happening in China and there's not going to be that demand that's going to drive some of these resource companies to kind of close that gap on the financials, actually being in broader companies, whether it's in healthcare, it's industrials, it's tech, consumer discretionary as well. I mean, retail sales just had some of their best years, some of their best months when I was looking at the NAB business confidence survey at the end of last month. So I think it's a really interesting play this year, OZXX. And even though people wanted to be in top 20 top banks, I think this year could be, we can talk about kind of our views for the year as part of our game plan, but this idea of market breadth or broadening, more companies benefiting in the greater rising of share markets rather than concentrated to the top 10 or top 20, whether it's in the US and in Australia, I think it could be a really interesting trade this year.
Yeah, this really stood out to me because I've got like the 2 competing thoughts in my mind. Like the banks are expensive, but I also want Aussie shares and I want good big companies. That's kind of what jumped out at me is I still want exposure to that kind of mid-rift of really good Aussie companies. I probably don't need the banks for that. Like I probably don't need the banks. If I want growth, I can put a FANG in there and that's more complementary than say, just buying the banks and then having a lesser position in that and then just trying to do something else. Like this kind of like sidestep that, if that makes sense, the way they blend together. So that was kind of my thing there. So there's obviously some really I think to temper expectations for investors, what I've been doing, Mark, is I've been like, last year was amazing. It's not uncommon, double negative, but it's not uncommon. It could happen when markets go up and they can continue to go up. But like 35 or 38% for gold, it's not something that you should bake into your retirement planning because it's not every year that we see that. Let's change. Let's go to some of the lesser performers. So in terms of some of the lesser performers, I mean, it's probably no surprise, but you've got things that are sharply negative that are leveraged.
Yep.
So like for folks that aren't familiar, can you just describe this? You're probably better at it, technically better at this than I am. So can you talk us through why some of these things, like I'll call one out, which is SNAS, S-N-A-S, the Global X Ultra Short NASDAQ 100 Complex ETF.
Yeah, as the name suggests, it is a complex product.
Yeah.
So this is a product that provides leverage, but on an inverse fashion. So if the NASDAQ goes up by 1%, the design of this product on a daily basis is to go down by between 2 to 2.75 times that. So just to be very clear for investors, these are very complex products. These are trading vehicles. These are not long-term wealth creation vehicles. And if you look at, on the other side, who were some of the best performers, well, it was its sister, the LNAS product, which is the long product, which does the exact same leverage, but not inverse. It actually just does it on the long side. So generally, when you're looking at your top and bottom performing tables for the year, you'll generally see these leverage products in there, but also on the other side, the inverse products be there.
Yeah.
If it's a bit of a choppy year where markets actually trend sideways, they'll probably kind of be hovering in that middle as well. So this is definitely, in my opinion, a short-term trading tool that people will probably have a very short-term time horizon. We're talking days, weeks, months, not years. I don't see this as a product that has, 5, 10, 20-year expiration. There are some light leverage products that have come out, which has been quite interesting to see kind of what adding a moderate level of leverage does to you. But I think the time horizon is really important because even though you might see LNAS did exceptionally well over the year, growing like 60%, and SNAS did the exact opposite, if you extend your time horizon, that's where you want to be looking at the core building blocks that can actually be doing, sustaining these levels of performance for multiple decades rather than these products. So yeah, would say is as part of the worst performing ETFs, definitely use them as short-term trading vehicles, not long-term wealth building blocks.
Yeah, I think that's really important for folks is just understanding that there's a time and a place. And that's, if people actually read the literature on these, the PDSs, that's exactly what they say. It says on there, they're complex. They're designed for this, which is shorter term. You wouldn't just put a buy and hold on this. Although I have heard of people holding these for reasons that I probably wouldn't consider to be valid are things like, I'm thinking the market will fall this year, so I'm just going to start buying it now.
The tough thing is with that, strong down days are followed up by strong up days, and that's where you can get really hurt. And it's why that we've seen even that kind of innovation go to single stocks. So
in the US.
we were looking at things like leverage NVIDIA ETFs, right, which does 2 or 3 times the price of NVIDIA, and then it fell 15, 20%. That's where things can get ugly. And then you've got companies like MicroStrategy, which are leveraged to the Bitcoin price. And there's 3 times MicroStrategy ETFs out there. And it's probably a matter of time before one of these do implode. I'm not saying that they will, but this is where you do have to be quite careful. We see a lot of flows coming into LNAS and SNAS on a daily basis, but we kind of exclude that from our calculations because it's just money coming in, money coming out. It's not the long-term holdings. So yeah, would advise people to do your due diligence, read the disclosure, understand how they work, especially around how the daily rebalancing works with these products, because the long-term benefit could be outweighed.
There's no real rhyme or reason to many of them, the other ETFs that feature in the kind of worst performer, the bottom list. But other than maybe there's a resources tilt to it, and meaning that like a lot of the, like 3 of the bottom, I'm just counting 3 of the bottom 10 are resources, which probably speaks to the uncertainty around China and commodity prices and that. Is that what you put down to?
100%. A lot of people are baking in that there wasn't going to be as much revival in the Chinese economy, particularly last year. There's been a little bit of earnings decline for some of these mining companies too. So a lot of people are just kind of waiting and seeing what's going to happen from one of the biggest, global economic powerhouses there is. And right now, there's peak pessimism in China. We've seen about 4 to 5 months of successive outflows from Chinese equity ETFs, which tells me that people are super pessimistic. And that's what kind of baked into a lot of the, share prices of a lot of these underlying companies. So that's why resources will feature quite heavily. That being said, there's the other side of things, which is around renewable resource and renewable energy. And there's been two sides where there's been some that have done quite well. Like we've had like copper, uranium do quite well, but then broader clean energy, whether it be things like solar power, wind, etc., which hasn't done as well. So there's been a bit of a barbell approach with resources in general, which is quite interesting. But I think, one of the main reasons on the poor resource performance for ETFs this year was the view that China just didn't recover.
Yeah. With it, I don't want to say everyone's wrong, but that has come up every few years.
Yeah, every few years.
As long as I can remember.
And even when the Chinese central bank and fiscal stimulus does come out, it's not enough. It needs to be a lot more, because they kind of make it analogous to the GFC, where as a percent of their GDP, it was a lot higher back then. So peak pessimism, but sometimes when things are pessimistic is where you want to be investing. And we talked about, can the US continue? Right now, all the analysts are saying that the US is going to grow by at least, 10, 12% in terms of S&P 500 targets. It's quite rare when there's so much bullishness happening. Yeah. So again, sometimes taking that contrarian view could actually make a lot of sense. And when people are down in the dumps right now about China, might actually be an interesting entry point, because China will eventually come back. And people are just waiting for that moment, but you got to get your timing right on both the exit and the entry.
Well, yeah, because, these are great companies like BHP, Rio, these are all wonderful companies. And not to bring Drew into the conversation again, damn it, Drew. But he does say to me a lot that the ideal time to sell a mining company is when the PE is low, the price earnings ratio, because that means the earnings are high and they're cyclical businesses. And when their earnings decline because commodity prices fall and their product that they're selling is falling, and they look like they're pretty ugly, that's often the time to really start thinking about them. And I do agree with that. So if we do the good, the bad, and then there's I'm calling it the good, the bad, and the closed. So there's a bunch of ETFs, and there are a bunch of ETFs that closed last year, Mark. Tell us more about these, but maybe actually before you tell us about the theme here, if you've identified one, maybe just tell everyone what actually happens if their ETF closes.
Yeah, it's a natural process when it comes to products. As product issuers, we're trying to issue products that can make investors money, but can also be commercially viable. And sometimes, for whatever reason, it's just too costly to run a particular product, or it's not in the investor's best interest for the product to continue. And we've closed products. There's been other issues that have closed products. It's a natural cycle. It's going to happen. So what generally happens, Owen, is when an ETF decides to shut down or close, remember, it's an open-ended fund, so you can be buying and selling it. It's not like a listed investment company or an active fund manager that has, a fixed pool of capital, or it can put up a lockup, in terms of accepting new money. An ETF will issue to the market to say, we're planning on closing down, and here are the specific dates. Here's your dates that the fund is not going to accept new applications in terms of creation and redemptions from the authorized participants. Here's the date that if you hold it, we'll be able to pay out the distribution. And that's what happens. All that happens in an ETF, because it's holding a liquid pool of securities, it'll say that on this date, it's going to sell those securities. You as the investor, once you get the notice, you can think, oh, okay, didn't know about that. Thank you for letting me know. I'm either happy to sell my fund before you shut down, right? Again, investors may have to incur brokerage on that, or I'm going to let the fund manager do it themselves. They're going to handle the whole wind-up process, and that's literally what happens. They sell the actual underlying securities as part of the final income distribution that you'll get. You will get those proceeds. Now, yes, and at the end of the year, you'll still get a tax statement, and there may be some realized capital gains from that. But they make it very, very clear in terms of the ASX or SIBO announcement that these are the dates, here are the reasons we're closing the fund. And a lot of the reason is due to the fund size, not reaching a commercial size that it can make it profitable or commercially viable to run. And that's where you're seeing a lot of the closures that happened last year, particularly, was funds that didn't reach critical assets. And that's what they came out with. A lot of the fund managers say it just didn't reach enough assets to make it worthwhile to run the fund, because it's going to cost money. Yeah. There's custodian fees, there's exchange fees, there's licensing fees around indexes. There's a lot of fees that go into building a product, which is why, even though, there are some, very low cost products out there, businesses still need to obviously make money out of it. That being said, it's all about passing the end benefits onto the investor. So fund closures are normal. We saw quite a few closures in the US, but yeah, in Australia was really interesting last year, and was we saw closures from active managers and closures, particularly from those active funds around ESG, so environmental, social, governance strategies. And I think that's a real telltale sign that we're in this phase that I'm calling at the moment green fatigue around ESG flows that going into particularly ETFs. Back a couple of years ago, counted for 1 in every $5 was going into ESG ETFs, and now about 2 to 3% of flows are going into ESG ETFs.
So 1 in 20.
Yeah, exactly. So it's been this almost, I don't think that in Australia that we're anti-ESG. I think we're actually leading. In the US, they saw like deep outflows in ESG ETFs. We're still in positive flows, same in Europe. I just think people, one, probably are mixing, I guess, one is they care about near-term profits rather than forecasting their profits out to 2050. You're seeing a lot of withdrawing from massive Paris-aligned agreements and, conventions that people, even big fund managers, big banks, are withdrawing from these pledges. So I think it's a very interesting time, and the investor dollars are speaking for themselves, and that's why you saw quite a few fund closures actually happen, which were ESG managers or even active managers who thought that they could build an ETF structure and that they will come, but it still is costly to run, and sometimes it doesn't make sense. So that's why we saw quite a few closures last year.
There's quite a few, actually. It's probably around about half of the 10 that close, or so thereabouts, are ESG sustainability type things. Yeah. Do you think it's here to stay though? Like the sustainable investing, the responsible investing?
Yeah, I think I do believe it. I don't think it's been destroyed. I think it's just, if anything, there's been a reallocation of capital. I think near-term profitability was important, a function of interest rate environments as well. When interest rates were high and rising, borrowing costs obviously rose for a lot of these companies that were in there. So I think people just didn't really. People did care about performance. At the end of the day, they want to do good. Don't get me wrong. Aussies do definitely want to do good in their portfolios, but I just don't think the dollars really spoke for themselves, and they went into other strategies. That being said, I'm a lot more bullish on investors, and we saw some of the worst performing ETFs were actually broad clean energy ETFs as well. And that was the second consecutive year that clean energy funds or renewable energy funds actually were the worst performers for 2 years in a row. Again, I talked about peak pessimism before. Could be a comeback, but I think Aussies are being a bit more granular with their exposure, and we're seeing a lot of interest, particularly with things like uranium and uranium mining. Very interesting year being an election year. Liberals coming in being very pro-uranium. A lot of big tech companies investing in their uranium capacity to pretty much power these data centers, and that's why we've seen a lot of interest in our Global X Uranium ETF ATOM, Adam. And not just that, but also the build out of this grid and this renewable energy needs copper. A lot of copper. So we're seeing a lot of interest in our Y ETF. And I think that's how Aussies are thinking. They want to be a little bit more tactical with how they allocate to renewable energy and do their own things, rather than going for these, I guess, broader strategies. And not just that, but active managers are still charging a lot of money. So why would I want to pay an active manager a lot of money for something that I can get in a low cost index option as well?
So let's talk game plan 2025. What's on that game plan for you as an investor, as someone who looks at this stuff every day? We've talked about big returns. We've talked about, obviously leveraged inverse ETFs are going to go down in a very strong year, but the resources being down and out, sustainable type ETFs being down and out, and that thematic being down and out a bit. Maybe not out, that's a bit brutal, but like just down. Where does that leave us if we bring it all together?
Yeah, I think we're thinking for our game plan for the year ahead for 2025 for investors to think about, there's probably about 3 or 4 key themes that we see happening. The first is around US exceptionalism. I know it's talked about quite a lot and there's a little bit of fatigue, but there really is this next level with the US, particularly now with Trump coming in being pro-business, pro-domestic focus, that the US will, at least that's what people are expecting, to lead again when it comes to equities. And I think that when you're looking at the US itself, we talked about the mega cap tech companies, but there could be, particularly with Trump focusing on, domestic production, tax cuts, it could actually favor a bit more of the smaller and mid-sized companies as well. And that's where we were talking before, that we might see greater breadth within the market. Now, there's been a lot of money flowing into small cap US ETFs. They've actually performed quite well. It's still been the US mega cap that have done really well, but I still see the US being a key powerhouse, especially with this domestic focus. US first is still going to be particularly a driver. It accounts for 70% of the global market. It's not going away anytime soon. And again, I think it's a pretty brave call to be underweight the US. So that's probably the first thing is I think US exceptionalism around EPS growth, free cash flow ability as well for some of these companies is still going to remain for this year. And that's what a lot of people are forecasting, that they're going to grow their earnings. Might be a little bit of volatility between these names, and that's where owning an index makes a lot of sense. The second is around artificial intelligence. And we're not just talking, we were chatting offline about what ChatGPT means. I don't think it's just also around the semiconductors that are going to power the chips behind these AI devices. I think it's going to be a bit more of this next leg up and this broadening around AI applications, whether it's in software, whether it's in enablers, platform providers. And we're recording this after the DeepSeek saga, which created a lot of noise, but it's actually quite beneficial for a lot of these companies to be able to employ these types of technologies at a fraction of the cost. So I think it's actually quite a bullish narrative for the whole AI in itself, and why maybe you don't just want to be in semiconductors alone, that you want to be in the broader application of AI. So I think that AI broadening trade as well, similar to the US broadening trade, but touching different areas, even things like cybersecurity as well. I think there could be some really interesting plays with AI and the build out of how to actually handle all this energy around the infrastructure within AI. That to me is going to be very interesting to look at this year. The power behind it, we did talk about. So around, copper, uranium, how we're going to actually fuel this energy intensive application. And then probably the last thing that we are looking for this year as well, Owen, is just to be wary of valuations. That doesn't mean to be not invested at all, but just monitoring it. And that's where we talked about strategies like GARP, or if we do experience a little bit of a reacceleration in inflation and we come in this stagflationary environment, that's not my base case, but just in case there is a potential, not necessarily a bear market, but all the fiscal stimulus come in, people are worried about government deficits, people are worried about geopolitical tensions rising as well. If we do see the inflation genie not put back in the bottle, that's where things like defensive assets, whether it's looking at gold, whether it's looking at fixed income coming back into fashion, could be quite interesting. So I'm not ruling out not being invested in equities, but still having that defensive part of your portfolio, also incredibly important. So yeah, there's a lot to do this year, and I think that's where the interplay between all these different factors is going to be really important for investors to balance out.
Yeah, it's interesting, particularly that broadening of companies like small caps. It's something I've been thinking about for a year now. And also the broadening of the AI thing. I can't remember. I was trying to think of the name of that curve where it's there's the expectations and the hype. Maybe it's the hype cycle. Maybe that's what I'm thinking of, where it's kind of that just shoots through the roof and then it drops and everyone's like, oh yeah, everyone's talking about AI. And then it comes back in a way bigger way. Yeah. I don't know what it's called. But
yeah, I know what you're talking about. You kind of go through these cyclical peaks and troughs around, you get peak euphoria.
Yeah.
Then there's kind of that drop and it's just oh, is it a fad?
Yeah.
And then you come back. It's oh no, this is actually quite important to our everyday lives. And even here at Global X, we're looking at how we leverage AI in whether it's product design, whether it's building automations and efficiencies. And I think a lot of people are using this in their day-to-day lives, which is great. But there's the commercial application of it. Cybersecurity companies are using AI to pretty much act as a line of defense to mimic the behavior of these malware attackers and how they can protect businesses. So there's real world application with something like this. And these companies are actually generating earnings. You're looking at the companies like OpenAI that did $5 billion in revenue. It's not the .com where, again,
it's not pets.com or whatever.
Because when you look at the PE ratios of these funds, and even our, Global X Artificial Intelligence ETF, GXAI, is trading at a forward multiple of about, 23 to 24 times, which is not crazy. Whereas when you look at the .com boom, when you look at their PE ratios, there was no earnings. With something like this, there was the crazy price, but there was no earnings. So these companies, and it's really around the efficiencies that is driving with these businesses. And we just think that it's not just going to be about semiconductors. We think this is going to broaden out to the platform providers, the enablers, a lot of the downstream impact within AI, which is still yet to be uncovered. So I think it's almost not necessarily that we're super early in the AI narrative, but I don't think this is going away anytime soon. And the fact that these big tech companies are investing a bucket load of money into it in terms of their capex tells me these are the smartest people arguably in the world. They're working for these giant companies. They know something. And if this is not just happening in the US with the likes of NVIDIA and OpenAI, they're now happening in China as well with DeepSeek, and who knows what else is happening. This is a global phenomenon that's not going away anytime soon.
I got to admit, Mark, we had Brian Hart, the former CEO of Westpac, on the show. He's now the CEO of a data intelligence business called Quantium, and he's in the CEO of the health CEO. And I was asking him the same sorts of questions on the show, and he was obviously super bullish. And I was trying to think of an analogy of remember when probably the internet first came out and people, remember not the internet because it was the 70s, but websites like .com, right? And people were like, what am I going to do with this thing, this internet thing? And then you're like, at first it was crap. It's kind of like the early versions of the blockchain. It was hopeless. No one was going to use that. But they did, people that found a way through. And I feel like with the AI tools pervading more of our lives, the AI agents, the auto, GPTs, it's just unbelievable.
And what's great is the internet evangelists were right. The internet does change everything. I mean, we don't leave our homes without our phones now, which
we're listening to this, watching this, right?
We're watching this probably on YouTube, on your smartphone, while you're commuting somewhere, wherever it is. But the problem is the infrastructure wasn't ready, right? And that was a consumer-led technology. Right now, this is an enterprise-driven technology. So all these big companies are almost the crash dummies for us innocent consumers. They're doing all the testing before it's, and that's where a lot of these savings, there's been modeling around the trillions of dollars that this could save. A lot of that is in labor productivity. It's not on the consumer demand side. There's a lot of consumer applications for it as well, but a lot of the big tech companies are doing the testing for us before this becomes the consumer-led. And I think that's one of the biggest differences between now and the dot-com boom. Yes, this technology is probably going to be revolutionary and change the way that we do business, the way that we interact, the way that I write an email, all this sort of things. But I think there is a distinct advantage, I guess a distinct difference between the two time periods. And that's where I think people who want to get exposure to this AI narrative can do it through things like big tech, because they're investing a lot of money into it, such as with FANG, or they can look a level lower and to go into the granular levels of AI that makes it up, whether it be, we talked about the semiconductors, the enablers, the platform providers, or in other aspects like the infrastructure and the powering behind it. I think this is a multi-decade theme that is still yet to play out.
I think there's so much low-hanging fruit for those mid-level tech companies. The big ones, it's obvious, but even that mid-level and the downstream sideways that are not just costing out, but also being here's a tool that we spent 10 years making. It's good. Here's this tool that we spent 10 years making with GPT-4 on it. Watch and see what happens. You will pay more for this. And I got to admit, I'm one of these people that are definitely paying more for many different things. And I don't think that's going away. I agree. I just think this year, we're going to see more and more and more of that.
Agreed.
Not to get too hypey on the podcast, but in everyday life, I am looking for the companies that are doing this and using these. This is a couple of companies that I don't think are public. A company like Zapier for folks.
I've heard of it.
Yeah. I don't think it's public, but if I could buy shares in that company, that would be the first company I'd look at their financials and be like, what is this thing doing?
And that's where you might see some more, we talked about it before, mergers and acquisitions, more M&A activity happening by these big public companies who I said before have huge cash balances, were buying back shares, and they are probably going to fuel more acquisition of private businesses who are investing in the space. And these are these little companies that you might not know about that are private, but are slowly becoming part of this flywheel that's in these mega cap companies. So by owning some of these big tech companies, you are getting that exposure towards the AI. May not be as pure play as owning something like GXAI, but you talked about it before. There's so much flood of capital being invested into us by some of the smartest investors we're talking about in the world, huge asset allocators, which to me says this is more than just an initial fad trend, whatever you want to call it.
Yeah. I like that, mate. Well, this is a great way to end the show. There's GXAI, which is an ETF that is specifically focused on the AI thematic. I'll put a link in the show notes to that, as well as the GOLD, GXLD. Is it?
Yep, that's our low-cost gold, but then our flagship gold product, GOLD, which is coming up to its, 22nd year anniversary now?
Yeah. What's the first gold ETF?
First gold ETF in the world.
Yeah, cool, mate. I'll put all the links to that in the show notes. But Marc, this has been heaps of fun, so thanks for joining me.
Thanks, Owen. Great to always be on the show and really enjoyed our chat.
Cheers. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.